This is Eric White, the founder of Vault Brokerage. Today I'm going to be talking to you about cap rates and what they are. So basically it's one of the metrics that are used to compare investments or apartment buildings one from the other. There's other different metrics such as GRM, price per square foot, price per unit, and cap rate. So it's basically if you're buying a building all cash, what your return would be year one, the cash flow. So it's not taking into account appreciation or anything else. It's just the cash on cash return if you're buying it all cash. Okay? So the way calculated is the gross income of the building minus a vacancy factor minus the timber operating expenses, and that gets you the net operating income. So it's the NOI divided by what you paid for it, what the price is your cap rate, or return on investment. So cap rates are important and they change. Typically in Los Angeles can be from 1 to 5% depending on where it is. Other things affecting that cap rate, it's all about risk and reward. The lower the cap rate, the lower your return. The higher the cap rate, the higher return. So if you're buying a property in a less desirable area, you're going to want a higher cap rate or higher return. And same goes with condition. If you need to buy a property that needs a lot of work and upgrades, you're going to want a higher cap rate. Other factors affecting that are a bigger building where there's less demand. Thus, you're going to get a higher cap rate. Supply and demand, as well as how much effort it takes, which affects the cap rate up and down. Okay, another big factor affecting the cap rate is the rents. If the rents are really low and there's a lot of upside potential in the building, then the cap rate, someone is willing to pay a lower cap rate because there's more upside potential. You have the ability to get it to a much higher cap rate. Let's say the market area cap rate is a 4 cap, but the rents on one building in that area are really, really low. Maybe I pay a 3 cap because the potential is to get it to a 6 cap rate, and thus, if I get the rents up, I'm going to make a return on my money. Okay. There's also positive and negative leverage and how that corresponds with cap rates. So if an interest rate is less than what the cap rate is, then you have positive leverage. If the interest rate is higher than the cap rate, you have negative leverage. The goal being to be positive leverage because you're borrowing at one amount and you're lending it out basically at a higher amount. If you have questions on that, feel free to call us and we can discuss it more in detail. That difference though is called the spread. So cap rate is just one part of the investment because there are other, the appreciation of the asset, the other depreciation. It's just a way of comparing and contrasting. So again, this is Eric White. Check us out at vault-brokerage.com or on Instagram, Facebook. Take care.